Silver at a breaking point. J.P. Morgan, physical supply constraints and the next market reckoning. 1. Silver at an inflection point. Silver is approaching what many analysts would describe as a true inflection point, a moment where long-term structural forces begin to outweigh short-term price volatility. Prices are hovering near historical highs, but more importantly, the underlying conditions supporting silver have fundamentally changed compared to previous cycles. This is not simply another rally driven by speculation or temporary macro fear. Instead, silver now sits at the intersection of monetary instability, industrial necessity, and institutional positioning. At the macro level, persistent inflation has eroded confidence in fiat currencies. Even as headline inflation figures, moderate cumulative price increases remain substantial, and purchasing power continues to decline. Silver, historically regarded as both money and an industrial metal, benefits uniquely from this environment. Unlike gold, which is primarily monetary, silver is deeply embedded in modern industrial processes, from solar panels and electric vehicles to electronics and medical applications. This dual role creates a demand base that is far less elastic than most commodities. At the same time, the US dollar faces structural headwinds. Rising debt levels, expanding deficits, and ongoing monetary accommodation weaken long-term confidence in fiat stability. Silver prices tend to respond not only to inflation itself, but to expectations of future monetary debasement. When investors begin to anticipate sustained currency erosion rather than short-term price pressures, precious metals often reprice rapidly. Market structure also suggests that silver is balancing on a knife's edge. Futures markets show heavy open interest relative to available physical supply, while volatility has increased even during periods of modest price movement. This combination often precedes sharp directional moves. The market appears compressed, with energy building beneath the surface rather than dissipating. Psychologically, silver is transitioning from a neglected asset to one that commands renewed attention. For years, silver lagged gold and broader asset markets, leading many investors to dismiss it as perpetually undervalued or structurally constrained. That narrative is changing. Institutional investors are re-examining silver not as a speculative trade, but as a strategic asset with asymmetric upside potential. Importantly, this inflection point is not defined solely by price. It is defined by positioning, supply dynamics, and confidence. When these elements align, markets tend to move decisively rather than gradually. Silver's current position reflects a system under strain where even small shocks, whether from physical delivery demands, ETF flows, or industrial shortages, could disrupt equilibrium. In short, silver is no longer simply reacting to external forces. It is becoming a driver of its own narrative, shaped by tightening physical constraints and shifting institutional behavior. Inflection points are rarely obvious in real time, but the convergence of monetary, industrial, and structural factors suggests that silver is closer to one now than at any point in recent history. 2. J.P. Morgan's dominant role in the silver market. J.P. Morgan occupies a uniquely powerful position in the global silver market, one that few institutions can match in scale or influence. As the largest custodian of physical silver in the world, the bank sits at the center of the market's infrastructure rather than merely participating at its edges. This role grants J.P. Morgan a level of visibility and operational control that fundamentally shapes silver's supply dynamics. The bank's dominance is most visible through its custodial relationship with the SLV ETF, the largest silver exchange-traded fund globally. Through this role, J.P. Morgan is responsible for safeguarding hundreds of millions of ounces of physical silver on behalf of ETF holders. While legal ownership resides with the trust, custody confers immense practical influence, particularly in how silver is stored, transferred, and classified within vaulting systems. J.P. Morgan's history in precious metals trading further amplifies scrutiny. The bank has previously been fined for market manipulation in metals markets, including silver, resulting in penalties exceeding $900 million. These cases involved spoofing and illicit trading practices, leading to the dismantling of entire trading desks. While those actions were firmly in the past, they remain relevant context for understanding why J.P. Morgan's current behavior attracts intense attention. Today, the narrative has shifted from suppression to accumulation. J.P. Morgan reportedly holds more than 750 million ounces of physical silver, making it the largest single repository of the metal in the world. This stockpile is not merely symbolic. It represents a significant portion of global above-ground investable silver. When such a large share of supply is concentrated within one institution's control, the implications for market liquidity and price discovery are profound. Crucially, J.P. Morgan's role is not that of a traditional speculative investor. As a custodian and market maker, the bank operates at the intersection of institutional demand, ETF flows, and futures market settlement. This positioning allows it to observe stress points before they become visible to the broader market. When J.P. Morgan adjusts its exposure, it often reflects deeper structural shifts rather than short-term sentiment. Whether J.P. Morgan's actions are defensive, opportunistic, or strategic remains open to interpretation. However, what is clear is that its scale gives it the ability to influence outcomes simply through balance sheet decisions. In markets where physical supply is tight and leverage is high, concentration of custody becomes a form of power. J.P. Morgan's dominance therefore matters not because it predicts price direction with certainty, but because it reveals where the pressure points in the silver market truly lie. When the largest custodian of physical silver alters its positioning, the signal is structural, not speculative. 3. The shift from paper shorts to physical silver. One of the most consequential developments in the silver market has been the reported shift by J.P. Morgan from a large paper short position to a predominantly physical long stance. This transition represents a fundamental change in how risk is managed within the silver ecosystem and carries implications far beyond any single institution. Historically, large banks and bullion dealers used paper short positions in futures markets to hedge exposure, facilitate liquidity, and profit from price volatility. These positions often dwarfed available physical supply, relying on the assumption that most contracts would be settled financially rather than through delivery. This structure worked as long as confidence in paper settlement remained intact. Between June and October, J.P. Morgan reportedly closed out roughly 200 million ounces worth of paper short exposure. This move freed significant capital, which was subsequently redirected into acquiring physical silver. For the first time since the rise of silver ETFs in the mid-2000s, the bank found itself both long paper silver and heavily long physical silver simultaneously. This is a rare and powerful configuration. Being long physical silver eliminates counterparty risk associated with futures contracts. Unlike paper claims, physical holdings cannot be defaulted on, rehypothecated indefinitely, or settled in cash during stress events. Ownership of physical metal provides certainty in a market increasingly defined by leverage and promises, rather than inventory. The shift also signals a change in perceived risk. Holding large paper shorts makes sense when supply is abundant and delivery risk is minimal. Reducing those shorts suggests growing concern that physical silver may become harder to source or more expensive to replace. In other words, the risk profile of being short silver has worsened. This transition also alters the balance of power in the futures market. When a major participant reduces short exposure, it removes downward pressure on prices that previously came from hedging activity. At the same time, physical accumulation tightens available supply, amplifying price sensitivity to demand shocks. Importantly, this move distinguishes J.P. Morgan's strategy from historical attempts to influence silver prices. The Hunt brothers relied heavily on leverage and paper contracts, making them vulnerable to regulatory intervention. J.P. Morgan's approach emphasizes ownership rather than obligation, reducing exposure to forced liquidation. While some argue that this accumulation merely supports ETF demand rather than reflecting a directional bet, the outcome is the same. Physical silver is being removed from the open market and placed into long-term storage. In a system already strained by paper leverage, this shift from promises to possession represents a structural change. 4. Evidence of tightening physical supply. Signs of tightening physical silver supply are no longer speculative. They are increasingly visible across multiple segments of the market. From rising lease rates to vault reclassifications and mint shortages, the indicators point to a system operating with diminishing buffers. One of the clearest signals is the rise in silver lease rates, which have climbed toward levels historically associated with scarcity. Lease rates reflect the cost of borrowing physical metal, not paper contracts. When these rates spike, it indicates that holders are reluctant to lend silver, often because they expect higher prices or fear difficulty replacing inventory. COMEX data reinforces this concern. Open interest in silver futures stands at multiples of registered, deliverable silver. Estimates place this ratio at roughly 244%, meaning paper claims far exceed metal available for immediate delivery. While this imbalance has existed for years, it becomes increasingly dangerous as physical supply tightens. Vault movements provide further evidence. J.P. Morgan reportedly shifted approximately 169 million ounces of silver from deliverable to non-deliverable categories. While the metal remains physically present, it is no longer readily available to settle futures contracts. This effectively removes supply from the market's safety net, increasing stress during delivery cycles. Retail and sovereign channels also show strain. The U.S. Mint has announced periodic shortages of silver coin blanks, limiting production of American silver eagles. Although retail silver remains available, these interruptions highlight fragility in upstream supply chains rather than end-market demand alone. Even operational issues have surfaced. Recent volatility reportedly contributed to outages at CME Group's silver trading systems, underscoring how tightly coupled price movements and infrastructure have become. When systems falter during periods of stress, confidence erodes quickly. Crucially, tightening supply does not necessarily mean silver disappears from shelves overnight. Instead, it means that marginal demand has a disproportionate impact on price. When inventories are thin, small increases in physical demand can trigger outsized market reactions. This environment favors holders of physical silver and challenges systems built on leverage. As buffers shrink, the margin for error narrows. Tight supply does not guarantee immediate price explosions, but it raises the probability that future shocks will have amplified consequences. Historical parallels and key differences. Comparisons between today's silver market and the 1980 Hunt Brothers episode are inevitable, but they are often misleading if taken at face value. While both periods involve rising prices and concerns over supply, the underlying structures differ in critical ways. The Hunt brothers attempted to corner the silver market primarily through leveraged paper contracts and borrowed capital. Their strategy relied on controlling futures positions rather than securing sufficient physical metal outright. This made them vulnerable to regulatory changes, margin hikes, and forced liquidation when authorities intervened. Today's environment is fundamentally different. Modern silver markets are dominated by ETFs, institutional custody arrangements, and globalized supply chains. J.P. Morgan's accumulation, whether proprietary or custodial, emphasizes physical ownership rather than leveraged control. This reduces exposure to sudden rule changes and limits regulatory leverage. Another key difference lies in demand composition. In 1980, industrial demand played a secondary role. Today, silver is indispensable to clean energy technologies and advanced electronics. This creates a baseline level of demand that did not exist decades ago. Inflation dynamics also differ. The 1980 spike occurred amid extreme monetary tightening, with interest rates eventually exceeding inflation. Today's policy environment remains accommodative by comparison, with real rates often negative or marginally positive. However, one similarity remains: confidence. In both eras, silver prices responded to shifts in trust, first in monetary systems and now in paper claims. The difference is that modern market participants appear more cautious about leverage and more attentive to physical constraints. Thus, while history offers lessons, it does not provide a blueprint. The current silver market is not repeating 1980. It is navigating a new paradigm shaped by institutional custody, industrial necessity, and systemic leverage. 7. Conditions for a silver price breakout. A sustained breakout in silver prices requires more than optimism. It requires specific conditions to align. Several of those conditions are already forming, while others remain potential catalysts rather than certainties. First is continued institutional accumulation. Hedge funds, asset managers, and sovereign entities increasingly view silver as underrepresented relative to gold and other real assets. ETF inflows, even modest ones, can strain physical supply due to silver's thinner market. Second is industrial demand. Renewable energy expansion, electrification, and technology adoption continue to increase silver consumption. Unlike investment demand, this usage is largely price-insensitive in the short term. Third is paper market stress. If a meaningful percentage of futures or ETF participants seek physical delivery, the system could face settlement challenges. Even isolated delivery events can trigger repricing as risk premiums expand. Fourth is macro instability. Currency debasement, debt expansion, or geopolitical shocks often accelerate capital flows into tangible assets. Silver historically reacts faster than gold once momentum builds. Finally, psychology matters. Silver moves are often explosive because participation lags until prices are already rising. When sentiment shifts, supply limitations magnify price action. A breakout is not guaranteed, but the ingredients for one are increasingly visible. Markets rarely provide perfect confirmation before moving. What this means for investors. For investors, silver's current setup demands clarity of purpose. Silver should not be viewed solely as a speculative trade, but as a form of insurance within a fragile financial system. Its volatility is a feature, not a flaw, reflecting sensitivity to stress rather than weakness. Physical ownership matters. While paper instruments offer liquidity, they introduce counterparty risk precisely when silver's hedge function becomes most valuable. Investors must decide whether they seek price exposure or systemic protection. Timing also matters less than positioning. Silver's sharp moves often occur quickly, leaving little opportunity to react once momentum builds. Gradual accumulation during periods of consolidation has historically been more effective than chasing breakouts. Risk management remains essential. Silver can experience deep corrections even within bull markets. Position sizing and patience are critical. Ultimately, silver represents a bet on constraints on monetary policy, on industrial supply, and on leverage. If those constraints tighten further, silver's role as both metal and money becomes increasingly relevant.